What is trade finance? Its simplest form, an exporter requires an importer to prepay for goods shipped. Bridge of funding between supplier and customer international level. Hi, Inshallah, I will explain about the provide and users of trade finance. The providers are: first is bank, suppliers, buyers, syndicates, and lastly trade fiancé houses. Now I explained the users of trade finance are 5 aspects. The users are importers, exporters, manufacturers, trades and producers. Product and services. Letter of credit. A letter of credit is a document from an exporter's bank to an importer's bank whereby an exporter will receive payment as long as certain delivery conditions have been met.
Letter of credit discounting. The exporter asks his bank for earlier payment rather than wait for the importer to pay. The bank discounts, reduces the payment to the exporter for the early payment benefit. Bill of exchange. A bill of exchange is a non-interest bearing written legal order used by exporters that binds their foreign customers to pay a fixed sum of money to another party at a predetermined future date.
Bill of exchange discounting. Bill of exchange discounting is when a company sells a bill of exchange before its maturity date at a value less than the face value of the bill. Bond, guarantee. A bond or guarantee gives the importer security of a financial guarantee in the event of the exporter's failure to deliver the contracted goods or services. Credit guarantee for exporters. A bond to cover any advance an exporter may receive from its customer. Usually the advance is used to buy materials to get prepared for a job.
Sources of trade finance. Banks, local and international. Suppliers credit. Investment management companies. Export credit agencies. Buyers credit.
The benefits of the system are 3, which is protection against risk of non-completion, protection against foreign exchange risk, and financing the trade.
Methods of payments. Cash in advance. With this payment method, the exporter can avoid credit risk, since payment is received prior to the transfer of ownership of the goods. Letters of credit. A letter of credit is a commitment by a bank on behalf of the buyer that payment will be made to the terms and conditions have been met, as verified through the presentation of all required documents.
Documentary collection. Funds are received from the importer and remitted to the exporter through the banks involved in the collection of exchange for those documents. Fraud. Documentary fraud, counterpart fraud, insurance scams, cargo thief scuttling and piracy in international trades. Foreign exchange risk. Risk in exchange rate fluctuation as due to various economic and political issue.
Country risk. Risk in political and economic stability of a country and exchange control. Bank risk. Poor stability and weaknesses in the bank involved in international trade.
Hello and welcome to Business Reporter's Digital Transformation 2018 campaign. I'm Alistair Greener and today I'm talking to Robert Barnes from Trade IX. Good morning.
Good morning, Alistair.
In an ideal world, how should an organisation obtain trade finance today?
Well, first of all, very easily, right? To do that, they should be able to go into their ERP system, be able to click on the information they need to share to access that, and they should be able to wait for a response to their request for trade finance. The bank should be able to consume all of that information and return a response within seconds to them. Clearly, that doesn't happen today.
Give me an idea of these more legacy systems, if you like, and how they and the technologies that are around at the moment are actually obstructing that ability to get trade finance in the easy way that we were hoping for.
Okay, so the legacy systems actually are at both sides. If you think about it, you've got the corporate here and you've got the bank. Now, the ecosystem is truly just not the corporate and the bank. It could be suppliers and customers, insurers, etc. But let's just take the corporate and the bank. The issue is that the banks have multiple siloed products, which in some cases are over 30 years old, that deliver trade products the way they prescribed them 30 years ago to the customer. The customer, on one hand, being the corporate, could be dealing with information that's locked within siloed systems on their premises, and they have to get information to the bank into these legacy systems, which are not just one, could be many, for the bank to consume that, make decisions, and then return a result to them. This, in some cases, takes months at the worst case. As I described at the beginning, we believe this happening in seconds, not months.
Despite the fact that that does sound like something that's difficult, as you say, it's got a lot of friction in it and it's not easy, there are going to be some skeptics out there who still will maintain that actually the older systems are better, that actually the simple thing of just going to the bank is easier. And there could be a CEO out there who's thinking, you know what, I'm going to stick to what I'm familiar with and what I know. What would you say to them?
Well, I think we'd take two approaches to that. One is seeing is believing. So the first thing I would do is I would switch on my computer, I would go on and I would show them a really live case of setting up and accessing a bank within a matter of a few minutes and getting that information to the bank and creating a transaction and showing a response. And then I would ask a lot of questions of the CEO as to how long does it take you today? How many people do you have involved in getting that information? What is the risk and the risk of the transfer of that information to the bank? And how fast does the bank respond to you? And then I would ask the last question and say, discounting all of that, are you going to get the best pricing based on the way you currently work with the bank today and the way you can work with the bank in the future?